Welcome back to the Maven Show. This is your host Rohit. Today we have David, the licensed insurance advisor. Thank you, David, for getting into the show.
Well, thanks for having me.
Awesome. So would you just like to give a quick intro about yourself, like how you got started with the insurance advisory and the financial advisory of yours?
Sure. Yeah. It's kind of, it's a long story, but I'll try to condense it and make it shorter. I think I had always kind of been interested in, but not necessarily insurance or financial planning, but always interested in like how banks and financial companies, like they're very like, I always thought of them kind of like black boxes, like people send them money and then at some point they somehow are making all this money and then it comes back out and then people like somebody's making money somewhere. And then there's like very wealthy people who do this stuff. And then, most people don't really understand it. And I was just always fascinated by that idea of like, there's companies out there and like all they do is make money. That's what they do. And they don't from the outside looking in, it doesn't look like they're making anything. They're just like money machines, like companies that just make money somehow, like doing stuff. And so that was fascinating to me. And I wanted to learn more about it. When I got into the business, I was approached by a company who, it was a recruiting thing that people, and because I already had that background interest, the company asked me if I wanted to take a couple of tests and find out if I would be right for the business. And so I went in and took their tests and like failed in spectacular fashion. Like basically, the manager said, I just don't think you'd be right for this kind of business. I don't know what he meant by that, but he said, you're not going to be good at selling people. You're not going to be good at this. He said, but you scored like off the charts on creativity, so I'm going to give you a shot.
Yeah, I get it. Awesome. So, recently the banking crisis has happened. So what thoughts do you have for the same?
So, I think there's been a lot of stuff in the news about, SVB and like, there's been a lot of commentary, about this by now. Like, I think when the last time we talked about this was sort of like, it was just getting going and people were sort of speculating on what was happening. And there's been a lot of people who have said stuff about, a whole bunch of different problems and what should have been done and what the bank did. And the interesting thing is like, I think the way that banks make money is really interesting. So like banks, they take and which was what Silicon Valley Bank did was they were taking in all these deposits from a lot of tech startups. And there was during a time when tech startups had when interest rates were much lower and when there was more investing going on in that sector, that there's just companies that had, these massive cash flows and they had to put them somewhere. So in Silicon Valley Bank happened to be like the bank where they were putting all this money. And so they had like massive deposit inflows. And during that time, like a lot of interest rates on bonds were very, very low. So you couldn't get a lot of yield on investment. So for a bank, like a bank would normally take money in, lend it out to other people, try to collect interest on loans. But in an interest rate environment where like bonds are paying almost 0% and US treasuries aren't at that time were not, now they're like, it's like 5% or whatever. Before, like as they were growing, interest rates were really low. You could barely get anything. So they were investing like all this money into treasuries. And then, I don't know if a lot of people realize this, but if you're holding, whether it's treasuries or whether it's some other bond, as interest rates go up, the principal on the bond, the value of that is going to go down if you have to sell it before it matures. So if you buy a bond for $100 and interest rates rise, your $100 bond is not worth $100 anymore. So if you have to sell it before it matures, you're going to get less than $100. So that's just essentially what happened to SVB. Like they had a whole bunch of people wanting their money back all at once, which is what a run on the bank is. And then they had the money, but if they had to sell their bonds early, which they had to cash them out early to meet all the demand.
So what thoughts do you have about the saving money or investing money?
Where do I begin?
No. Both are the different things, but I think, what do you prefer people should have? Both or just one?
Both what?
No, I mean, like, should they be just considering the investing money, or should they be just considering the saving money, or just both, you know?
It's sort of like, I don't think it's one of those things where you choose one or the other. You can kind of think about it like saving, like when you're accumulating money, when you're actually saving money, you're finding like basically like a place to hold the money until you figure out what you want to do with it. And then investing is when you have money, when you decide you want to invest money, then it's basically like you decide that you have money that you can afford to risk, and you invest it in something where you're going to put it at risk, which you might make some money, but you might lose it. I grew up in a small farming town, a lot of dairy farms, a lot of like cattle farms, stuff like that. So I can remember back when I lived in that area. I moved out of that area more like into the city. But I can remember like at one point like going out and visiting some of these farms, because it was common, like where I lived, like, a lot of people would go to, like, instead of going to the people would shop at grocery stores, but instead of going to the grocery store, like if you wanted to get meat, and people had like these big chest freezers and everything, you lived out in like really rural areas. It was common for people to like, they would go hunting, or they would just go directly to the farmer and be like, I want to buy like half of a cow, or I want to buy like, chickens in bulk, right? So then you put them in your freezer and you just have food. You just like have food in your freezer. I can remember my parents doing that, just go directly to the meat packing plant, just buy stuff, and then had a big chest freezer. So I like, and when I was kind of looking around and shopping around at a farm, like when I was out on my own and had the opportunity to do that, I went to this one farm and it was really cool because they were showing me around, and they were showing me kind of like how the operation worked. And they said, that the animals were like the cows were able to graze on grass out in the pasture. They had like an open shelter where they could kind of go in and out. I mean, it was like a really luxurious life for a cow. I mean, it was a really luxurious life. And chickens, they were roaming around, and like they had rabbits and stuff and all this, and they had all this different thing. So anyway, and they said, it's really important that you treat the animals really well. The farmer was telling me, like, the animals should never know or never suspect that they're going to be processed, because if they get nervous or something, it kind of, they were telling me like somehow it affects the meat quality and everything else. I have no idea, but this is what the farmer was telling me. And, it's kind of like they just have no idea what's about to happen to them until it happens. And I feel like that's sort of like in some ways sort of like a metaphor for what happens to a lot of investors. Their past experience, they're sort of like I mean, maybe that sounds a little gruesome or whatever, but their past experience is sort of like they invest money in the stock market or whatever, real estate market, and they sort of get accustomed to like the way the market works. They say, well, historically, stocks have returned 10% or whatever. Real estate, I've always done really well in real estate. And they just assume like their past experience is indicative of what's going to happen in the future. And the reality is the past doesn't mean anything. Like your past experiences don't really mean anything, because the future is never predictable. Just like those farm animals, like there's no way they could have predicted what's going to happen to them. Most investors are kind of in the same, like I said, again, it's like a metaphor. Like a lot of investors are in the same boat. Like they have no idea what's going to happen to them in the future. Some of them are going to be fine. A lot of them are going to be very surprised, I think, by what's going to happen in the next couple of years. I'm sorry.
Real estate investment is stable. Like stock market is risky. It is risky. I think it is. As comparison to this capital market, where we buy stocks, or where we may do forex, or maybe do crypto, whatever the things are. This is high volatility is there.
Extremely high volatility. Like stocks are risky, real estate's risky, but even individual bond, like that's the story of SVB, right? Even bonds even investing in US treasuries can be risky under the right circumstances. Like if you need money right now, you don't want to own a 30-year bond. Because if you need the money, you're going to sell it for a loss. So a lot of it, when people are looking for savings, they say, well, I'm just going to put it in a savings account, assuming that there's no run on the bank, right? Then you'll be okay. So what a lot of people have done, and one of the places that people put money, in fact, banks put money there, and very wealthy, even people like billionaires. Michael Milken is a classic, is like a high profile example of this. Michael Milken's family, they put a lot of money into whole life insurance.
Yeah.
And it doesn't sound like a very, I don't know, glamorous product, because it sounds boring. It's like life insurance. It's very boring. And that's kind of the appeal to it. It is boring, and boring in a sense of like, it doesn't attract a lot of attention. It doesn't attract the attention of like taxing authorities, of regulators, so it's a very quiet place to put money, and it's guaranteed against loss. And you get a competitive rate, something that's competitive to like fixed interest, but it tends to pay a little more. And it's guaranteed to grow every single year, which is why banks and a lot of wealthy people really like to put their money there. And not just wealthy people, like a lot of people who are younger folks are kind of knowledgeable about that kind of thing. Who like their dad had a policy, and so he's like kind of pass it down through the family, like the knowledge of, hey, this is what you do with your money. That's where people put their safe money. That's where a lot of people are putting their safe money.
Gotcha. So any best advice do you have for anyone who is making the financial decisions or self-financing the business? Any best advice do you have for anyone?
Self-financing a business. I mean, a lot of people, if you go back to like the 1970s and 1980s, people used to do it with something called like passbook savings accounts. Yeah. You would put money in a savings account, then you'd borrow money against your savings account. You could leave your money invested, so it would still earn interest, but you also got the money that you needed. Those aren't really that popular today. It's really difficult to find something like that.
Banks interest are as low as it's real low.
Yeah. So what people do, so something that has existed for almost 200 years. Yeah. Again, whole life insurance. So you building up credit. Basically, you can build up a capital and savings inside a life insurance policy, and you can use that to finance. You can use that to finance a startup of a business or business growth, business expansion. And it works just like any other loan, except for the fact that you own the policy, as opposed to you going to like a bank or something. You just go to the insurance company and say, hey, I need some money. The loan is backed up by your existing capital that's already built up inside the policy. So you own $1 million policy. Whatever the cash value inside the policy is, that's how much you can borrow against. And it works just like an equity line of credit. You can access it. Interest accumulates just like a normal loan, except for the fact that when you pay them back, you are paying back principal before you pay interest on the loan. So it actually works out to be a very low cost, probably one of the lowest cost loans you could get as a business owner, cheaper than any other line of credit that you would get. And it's something that you actually own, as opposed to you having to fill out credit applications, go use the bank's money, or go use venture capital or somebody else's money.
Get it. Awesome. Well, thank you so much, David, for getting into the show and having these thoughts of yours about financial planning and budgeting and self-financing in business. So yeah, thank you so much for having on.
Yeah, thanks for having me.